There are probably two things that we can all agree on. Number one, the world is highly unpredictable. And number two, it's always nice to add a little bit of certainty to our plans. But how do we do that? Well, annuities are one such way to incorporate certainty. And today we talk about them. I interview Sanjiv Tidke, our insurance specialist. He's the one that we bring in on life insurance cases and annuity cases to get us the right product. So look forward to a great conversation with Sanjiv. Sanjiv, thank you so much for coming. I appreciate it. Today we are talking annuities. Don't go anywhere, everybody. This will be an interesting discussion. But I'm always amazed at how often annuities get brought up in conversations with clients. Particularly, it gets brought up when we're converting an RSP to a RIF. And that was always a question mark for me until I did a little research and found out that before 1978, you were forced to convert your RSP to an annuity. So there's probably some memory of that out there. Since then, you are allowed to convert it to a RIF. You're allowed to have more flexibility. Those came about. But still, I wanted to talk about annuities today with you, our insurance expert. So, number one, Sanjiv, what's an annuity?
Well, first and foremost, thank you so much for inviting me over, Bryan. It's a pleasure to work with you and your team. Going back 2012, it's been 12 years in the making. You guys have worked together. That was prior to my daughter being born. So it's been a while. Thanks for the opportunity. So annuity is a legal contract that a buyer purchases from an insurance company. They write a check to the insurance company, and the insurance company then guarantees you a stream of income for a duration you pick. Okay. You can choose from 2 years to life. The option is fully in your hand, and that's what an annuity does. It basically guarantees you income for the duration you choose. Now, there are certain types of annuities out there depending on what duration you buy. So there is something called as term certain annuity, which is for a specific short duration, which could vary from 2 years to 30 years. There is something called as term certain to age 90, which goes from when you purchased your age at that point to age 90. And then there is something called as life annuity, which is something that will pay you a fixed guaranteed income from the time you purchase till the time you pass away. A fixed guaranteed income is paid to you. So in the essence, it's guaranteed income for life.
It's guaranteed income for life. And when we talk about this, about writing checks,
yes,
you can write a check. You can also transfer your RSP,
absolutely,
your LIRA, whatever that may be. So
that is
it's
correct.
Money going to an insurance company. So you're converting the lump sum into a stream of income payments, as you just said. Okay.
Absolutely.
So who does this?
Well, number one, the clientele that is interested in buying annuity, the first concern they have is that we will run out of money. We will run out of our capital that we need for retirement. Okay. They are ones who are a little concerned that we may not want the volatility of the market. We want a surety and we need guarantees that this money is going to be there with us from now until we pass away. So those are the clientele that typically would buy an annuity. We generally see clients who are in the age band of 65 to 75 are predominantly the ones who would talk more about annuity because they are in that phase that they are either retiring or have retired and they don't want to see the volatility in their retirement income or they can't digest the volatility of the market. Those are the clients typically that they go for.
So are people, taking their entire RSP and moving it over, or is this part of their savings? How does it look in that? So generally speaking,
we would never advise any client out there to take the entire RSP, put it in an annuity, and just have a guaranteed income for life. That is not something that we advise. Typically, a portion of your fixed expenses that you have, that you want to make sure are covered, are the ones you would go with an annuity.
Got it.
Now, I was talking to you earlier, we were talking stats, and I was giving you some numbers that, in Canada, to give you an idea, back in 2022, our population was roughly 39 million. of that 39 million, roughly 9,500 individuals were age 100 or over.
Centenarians?
Well, there you go. That's
All right.
exactly
That's the
what
big
it is.
Scrabble word right there.
Well, exactly. I was just trying to make it as simple as possible. So the predominant risk that some people are worried about is, okay, what if I live to age 100 or 110 and I'm going to run out of my money at that time?
Yep.
In realistic terms, if we were to look at those numbers and say, well, we had 39 million and we only had 9,500 of them, so we're talking about 0.024% chances based on those numbers that an individual would have lived to age 100. That is...
But, we all have a family history, and
Correct.
suppose your mother lived to 102 and you have a
Correct.
similar genetic build, you might want to immunize yourself from
Absolutely.
that.
So there is that point that you would certainly see that, okay, there is a risk and we would want to cover for that. And for that, annuity would make sense for a small portion of your portfolio. I would not say that it should be something which would be done on the entire portfolio for that matter.
So okay, well, here's what everybody wants to know is,
Okay.
so how much do you get?
Well,
So
that's
how much, so if you're 65, how much do you get? If you're 70, how much do you get?
The payout on annuity depends on the structure of the annuity that we do, whether we do a single annuity or we do a joint annuity, which is for a couple for that matter.
Yes.
Whether we are doing a term certain annuity for 10 years or whether we are doing a life annuity. What kind of guarantee periods do we add, or bells and whistles, in other words, are added to the annuity? Now, just to give you an example, and we have to run these numbers for every client when we are looking at annuity options on different bases to make sure that we've run all numbers in different scenarios and then give them the best option. So if you're looking at the chart right now, if an individual, say male age 65, deposits $100,000 into an annuity, may roughly see about $7,368 on an annual basis. Now, these numbers of annuity change from time to time because insurance companies are competing. They depend on the client's age. They depend on whether they're male, female. It depends on the prevailing interest rates and whatnot. So these rates do change. Now, at the time we ran the quote, that's the number you're looking at, $7,300 or dollars for $100,000 of deposit. Now, not all of this $7,300 is pure interest. So we can't say the payout percentage or rate of return that a client is getting is 7.3% for that matter. All we are saying is the payout is $7,300. Of the $7,300, there is a small portion which will come in as a taxable income to the client, but majority of the money is coming back on a tax-free basis.
So that's if the money is non-registered.
That is correct.
But if it's a RSP, it's all income.
Absolutely.
Okay.
So that you hit on a great point over there. Taxation of annuity depends on the source of funds used to purchase an annuity. So if an annuity is purchased from an RRSP or if it is purchased later from a RIF, then all the income produced from the annuity is going to be taxable income. But if it's coming from a non-registered account, then a portion of it is taxable and a big portion of the annuity is tax-free. So that's as far as the 65-year-old is concerned. Having said that, as you get older and if you've purchased an annuity at a later age, then the payouts could be much higher. So for example, if we purchase the same annuity at age 75 instead of purchasing it at age 65, now we're looking at $8,400 per year on a payout if you had deposited $100,000.
Okay.
So now the payout looks like 8.4%. Now 8.4% is not a rate of return over year. Again, it is just a payout percentage.
A payout ratio.
A payout ratio to your deposit. So the later you purchase, the higher it is. But there again comes a point where it's like, well, we are reaching 80 right now. Do we want to buy an annuity at this stage? Then what we would ideally recommend, and this is what we do for all of our clients, is that you may want to run some financial projections first to see how much income you need, how much risk can you take, how long your income is going to go, what your expenses are. We generally use indexation to kind of see, okay, given that inflation has done what it has done in the recent years, if something like that continues, would you still have the money or run out of it? And then we do the numbers looking back, saying, okay, annuity may make sense in it. It doesn't always work for everybody, but in some cases, it will certainly work.
So as you get older, the payout naturally gets larger. So to me, this kind of, if my parents, were 104 years old, both of them right now, an annuity would make a lot of sense because I would feel, hey, I'm going to win against the house. Like they don't know that I'm super healthy. I'm going to live forever. The insurance company is going to pay for it. So that makes sense to somebody. But maybe you've had some health issues in the past and you go, well, I may not live to life expectancy. So I don't want to engage in this because I'm going to lose.
Correct.
So how do you speak to somebody like that?
Okay, well, that's actually a very valid point because as human beings, we know that there is one thing certain, that we will pass away at one point of time, okay, which is where life expectancy comes into play. What's your probability of living to age 90? What's your probability living to age 95 or age 100 for that matter? Somebody who's had health issues, and we're talking about significant health issues for that matter, because a lot of chronic illnesses, diabetes, cholesterol for that matter, are something that can be well controlled for that extent. What we are talking about is serious illnesses that would really drastically reduce your life expectancy. So we are talking about cancer, heart attack, stroke, those kind of illnesses. There is something called as impaired annuity for that matter, where an insurance company would come to you and ask you a whole host of medical questions. They look at your medical files, sometimes they may even write to your doctor to get the report. If they deem that your life expectancy is lower than the general public, then the payout of that annuity can be significantly higher than something which you may be able to buy on a regular annuity, which is for a regular individual who doesn't have that. So yes, there are chances that there will be a higher payout on an impaired annuity.
Got it. Okay. So if you've had health issues, significant health issues in the past, that shouldn't disqualify you from thinking about this.
Absolutely.
If that's of interest to you.
Absolutely.
So walk me through the steps here.
Yeah.
Because it's kind of like the opposite of life insurance.
Yes.
Like it's not as onerous as revealing all of your different medical histories. So if somebody's interested in this, what is the process? Aside from the financial planning aspect.
Yes.
Assuming we've gone that far and we've decided $250,000 should go towards an annuity, you come in, how does it go from there?
Okay, so typically what we do is that we have a medical questionnaire that we would go through with the client, where we ask all medical questions about their health. Next is their doctor's information. We submit this information to the insurance company.
So this is on an annuity?
This is on an annuity.
So you are getting medical information just to fish and to see if we can get a better payout?
Absolutely. So sometimes on anonymous basis, we reach out to the insurance company without providing client information altogether. So we don't provide your name, address, or any detail. We position it as, here's Mr. John Smith. Here's the medical information that we have on the file for him. Do you think the client would qualify? Insurance companies in most cases come back to us because we've pre-screened clients. Sometimes if clients tell us, well, I only have diabetes, but I'm fine, everything is in good order, that doesn't necessarily qualify somebody for an impaired annuity. But if we have somebody who said, yes, I've had a bout of cancer, have had to take treatments, we've gone through chemo, surgery and whatnot, then absolutely we take that information, go to the insurance company. If the insurance company hints that yes, we feel that this would qualify, then we further pursue the case by reaching out to the client, taking an acknowledgement from them as far as releasing the medical information to the insurance company on their name, and then providing the insurance company the authorization to reach out to their doctor to achieve an APS is basically where it goes. The insurance company, they underwrite this. So this is where medical underwriting comes in, where somebody looks at it and then there is an underwriter who would come in, check your medical questions, check what they have provided, what they've got from the doctor, and then make a decision to tell you that, yes, you're age 65 and this is what you're applying, but based on your medical condition, we believe that your life expectancy is lower, So we will increase the payout, and here is the offer. Once the insurance company makes an offer, then it's up to the client if they accept the offer. If the client accepts the offer, then we go about doing the application process for the client, which is the actual paperwork that here's the client, here's the information, here's where the money is coming from, here's either a direct transfer form or here's a check for the purchase, and then we go ahead with the purchase of an annuity.
So 2 weeks later, a client has buyer's remorse and says, I shouldn't have handed over all the money. Can you return that shirt and get an exchange or a refund, or can you reverse this?
Okay. Well, the good news is in Canada, we have a 10 days free lookup period.
10 days.
10 days free lookup period. From the date you have received the contract, you have gone over the contract, and by the end of 10th day of receiving the contract, and that is meaning you signed, you gave the receipt of acknowledgement that I have received the annuity contract. From that day, 10 days. So for argument's sake, you got it on the 1st of January. You signed and gave it back to the insurance company on the 1st of January. Then you have up until the 10th of January to decide that now this is not good for me. I don't want it. So if that's the case, then you get your money back. If the monies came from a registered account, then it goes back into that registered account. Of course, if it has come from a RSP, depending on the age at that point of time, it would have to go back either into that RSP or into a RIF.
But you have 10 days as a cooling off period almost.
Absolutely, you do.
But in a month or 2 years, it's a one-way door.
Well, which is the biggest question that we have to explain to the client for the most part is that annuity is a legal contract. It is established between you and the insurance company. Once that contract is established and a payout commences, then it is set in stone and there is generally no reverting back from that.
Yep.
So it is something that we really, really talk to our clients very in details, that once we set it up, it cannot be reverted. So that's the reason why we don't try to put everything into that basket. Yep. We want to make sure that clients who have a need of income are the ones who look at that, and especially those clients who cannot accept the volatility of the market. But this is not something for every single client.
Got it. If this is of interest to anybody, talk to me. We can go through the generalities of it all, how much income might be interesting to create from a fixed side, what the payout rates might be. I can get some preliminary numbers just to see the range.
Absolutely.
And then if things are getting a little bit more serious, we would bring in Sanjiv to really do a more thorough analysis. Again, no commitments have been made, but we kind of triage it down to see what it all looks like.
Absolutely. We would go that whole 9 yards of making sure that it is the right thing for you and it works in your best interest. Now keep in mind, at the end of the day, annuities sometimes are also purchased from open money, which is from a non-registered account. And when you're in your retirement stage or your retirement age, we have to be cognizant about other government benefits that you are eligible for. Okay. And we try to ensure that, hey, we want to have products in there which will produce income, but we don't need that much taxable income. Because guess what? You do receive old age security post age 65. But that old age security does have certain thresholds under which everything is okay. But once you hit that income number of 90,000 odd, depending on the year, when you're looking at it, we are in 2024, 2025 would be a higher number. Again, it's indexed. If you exceed that number, then OAS could get clawed back. So these are certain things that we run in our plans to kind of make sure that we're not exceeding those numbers.
Got it. Sanjiv, thank you.
Oh, you're very welcome. I'm glad to be here, and I hope to be here again. Talk more.
We will talk more insurance as the months go on. Thank you so much.
Absolutely. Thank you so much for having me over.
Thanks, Sanjiv.
Thank you.